Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields continue to push yields lower. Didn't get outside of the range, but it's starting to feel like we're pushing towards 280 and possibly below. We haven't been this low in over a month, and it seems that the Treasury market has all along been seeing something that the rest of the world, whether it be equities or commodities or the dollar or the politicians in Washington, haven't been seeing, as they've been cautious. We got to 3% not too long ago. We were unable to push through it and ascend towards higher levels, which would come hand in hand with stronger economic growth and a Fed that wants to raise rates. And now in foresight, we're seeing that the market has seen the flight to quality bid that we expected. Some of us have expected all along, but now we're just starting to see come to fruition. And I think that right now, the real threat here is the net core short positions in the Treasury market. And how will they react if we push below 280? We've seen a lot of call buying, which is essentially insurance policies on yields going lower. That is starting to get a little bit expensive. And I think that directionally, if we see bond prices continue to rise, that you're going to see a lot of those shorts get the squeeze. They have started getting out over the last several weeks, but not very quickly. And certainly a lot of shorts out there that are probably starting to sweat if we push below 280 yield. We haven't done that yet. We got a little bit of a rise in yields towards the end of the session as stocks saw a little bit of a relief rally. But I think ultimately the trend right now, that 280 to 3% trend, it's now odds are pushing that we're going to see a trade below 280 before too long. And if you look at market volatility, you would think it would be spiking higher, but we are elevated, but we're not moving at a fearful pace. Market volatility is higher, as I said, and I think it should stay at a sustained level, but we're not looking at it as an, oh my gosh, what do you do? Sort of that panic fear that we would expect to see if yields do break outside of a range as significant as 280 to 3%. So volatility is elevated, but not yet showing that there's any real concern. I think if we bust below 280 and those shorts start to squeeze out, then you'll certainly see a major bit of volatility. And lastly, let's look at the curve. How does the curve reacted to all this? Well, he got 10-year note, 2s traded below that July 18th low. And right now it's lowest in over a decade, something, we continue to say. But after that modest little steepening we saw, we've now seen it re-flatten to lower levels and probably going to continue to trend that way, especially if you look at a Fed that's going to raise rates at least once, maybe twice in this calendar year. Now you're questioning whether or not they're going to be able to raise it all in 2019, not from the Fed, but from some of the naysayers. And I think that right now that if you look at twos, they're going to be parked at a much elevated level. And if you start to see a flight to quality bid in the Treasury market, it's going to be buyers of the back end of the curve, which should push that 2s, 10s, 5s, 30s, whatever you want to call it, towards zero, and dare I say inversion. So right now inversion is the key risk. If we get that, then that's going to change a lot of people's portfolios. So right now we're looking at 10-year probably hanging into that 280 level, marrying to that 280 level a little bit. If we get through it though, it could be a very big push and a rally in treasuries, one we haven't seen in a long time. This is Todd Colvin coming to you from the floor of the CME Group.